Good morning, good morning, good afternoon, depending where you are. Thank you for joining us today to learn more about the Main Street Lending Program and specifically understand some of the updates that were presented by the Federal Reserve yesterday. Please post your questions in the Q&A only. The moderator will not have time to look at questions between chat and Q&A. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. And later in this day, we will also email a copy of this presentation and the slides to participants. A little bit about myself. I am the founder and CEO of Multifunding. I'm an Inc. columnist writing regularly on business lending issues. I've advised prior administrations about the small business credit markets, as well as regularly working with the Federal Reserve Bank. I am an author of the book out called The Growth Dilemma, and from my entrepreneurs organization friends out there, I'm a proud member of EO Philadelphia. My lawyers asked me to share some disclaimers with you. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. Multifunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. And we encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for business owners and entrepreneurs to be figuring out what is next for their businesses. This is the time to prepare for battle, and as we reopen and rebuild our businesses or pivot them, it is going to be hard work. What is your strategy? Will you pivot 5%, 50%, or 90%? What will your team look like? And what ammunition will you go to this battle with? And in the case of this battle, ammunition is cash. How much cash will be required to get your business back on a stable footing? What is the best case and the worst case scenario? And where will this cash come from, and how much are you willing to personally risk? What does your future look like as you rebuild your business? What opportunities are you considering? Today, I'm excited to talk to you about the Main Street Lending Program, which is expected to formally launch any day. It is a part of the CARES Act and has $600 billion allocated towards it. It is in effect until September 30th, 2020, and is comprised of 3 facilities: the new, the priority, and the expanded. I just want to important to put some context. The Main Street Lending Program is not an entitlement program like the PPP. Effectively, everyone who applied for a PPP got one, irrespective of how well their business performed last year. If your business performed poorly last year or had negative EBITDA, you are not a candidate for a Main Street Lending Program. If your business has been hit badly by COVID-19 and you believe you are a candidate for a Main Street loan and want to get one, your best chance to get one will be through your existing bank. But if you plan to use an Main Street loan to expand and grow and for more opportunistic purposes, more banks will be open to you besides your existing one, especially if they do not offer them. These loans will be offered through banks, savings associations, and credit unions. But unlike PPP, where these loans were available at almost every bank across the country, we expect there to be maybe a few hundred lenders who participate in this program. To be eligible, your business must be established prior to March 13, 2020. If you or your affiliated companies have combined more than 15,000 employees or 2019 annual revenue of $5 billion, you are too big to qualify for this program. You have to be created or organized in the United States with significant operations in the United States. What is the U.S. eligibility test? An eligible borrower has significant operations in the United States if, when consolidated with its subsidiaries, greater than 50% of the eligible borrower's assets in the United States, annual net income is generated in the United States, annual net operating revenues are generated in the United States, or annual consolidated operating expenses, excluding interest expense and any other expenses associated with debt service, are generated in the United States. A U.S. company that is a subsidiary of a foreign company is eligible and can apply as long as none of the money flows up to the subsidiary outside of the United States. Eligible business types include partnerships, LLCs, corporations, associations, trusts, cooperatives, a joint venture with no more than 49% participation by foreign business entities, or a tribal business concern. Ineligible borrowers include developers and landlords and specific other industries such as speculative businesses. As an example, a private equity company cannot apply because it is considered speculative. Affiliation rules apply here. So if you own or control more than one company, you have to combine the debt, EBITDA, employee count, and all these are things to determine your eligibility. The affiliated group loans cannot exceed the maximum loan amount for whatever facility you pick. Now let's dig into some of the changes. There are three major programs in the program: the new, the priority, and the expanded. The new and the priority share some attributes. They are a secured or an unsecured term loan. While the Federal Reserve does not require a personal guarantee, it is at the discretion of the participating lender if they want to ask for a personal guarantee and try to get one. These loans now have a 5-year maturity instead of before they were a 4-year maturity. Principal payments are deferred for 2 years and interest payments are deferred for 1 year. So you pay nothing in 1 year. In year 2, you start paying interest. And then at the end of year 2, and then you don't make a principal payment till the end of year 3. Principal payments of 15% are due at the end of year 3, 15% at the end of year 4, and 70% at the end of year 5. These rates are an adjustable rate of LIBOR, the 1 to 3-month index plus 3%. Currently, the rates are between 3.18 and 3.31%. Prepayment is permitted without penalty, and the fees to get in are between 1 and 2%. For the new facility loans, the lowest amount of loan is $250,000. That's different from the $500,000 they had to be before. And the highest now is $35 million versus the $25 million it was before. To calculate how much you're eligible for, you take 4 times your 2019 EBITDA minus your existing debt. So to take an example on row 3 of a company with $500,000 of 2019 EBITDA, the maximum loan facility they could get is $2 million. If you subtract their existing debt of $1.5 million, that gives them a potential new money loan of $500,000. You take the same thing in row 1, and this company had $500,000 worth of existing debt, they could get a potential new money loan of $1.5 million. In case of bankruptcy, the new lender, how do the rights of your new lender compare to your existing lenders if you get a new loan priority? In case of bankruptcy, the new lender must have the same rights as other lenders except for your mortgage lender. But in the normal course of business, the new lender's rights can be subordinate. There are some distinctions of whether a Main Street loan will be secured or unsecured. However, what is important to note is that you can take new secured or unsecured debt after receiving a Main Street New Loan Facility loan, providing that the debt would not have higher contractual priority in bankruptcy than your new MSNLF loan. Now let's talk about the priority facility. These loan amounts are now between $250,000 and $50 million. It used to be between $500,000 and $25 million. Taking again the example of a company with $500,000 of EBITDA in row 3, on the priority loan facilities, they're not to exceed 6 times that of $3 million. If their existing debt is $1.5 million, they could get a potential new money loan of $1.5 million. To go to row 1, that same company with $500,000 worth of existing debt could get a potential new money facility, priority money facility of $2.5 million. What is unique about this program is that you can refinance existing debt as long as it is not with your Main Street priority lender into the terms of the loan. And these loans, the lender's rights are senior or on par with all other lenders except for your mortgage lender. And there are distinctions between what makes it a secured or an unsecured loan. As a baseline scenario, a company with $41,000 of 2019 EBITDA and no debt could get a Main Street Priority Loan Facility of $250,000. Now let's talk about the expanded loan facility. And if we are, based on our understanding of the new programs, this has changed quite a lot. An expanded loan facility is a tag-along facility with your existing lender. So to state an example, a company in row one of $10 million of 2019 EBITDA and $25 million with existing debt. The highest loan they could get is $60 million. So if they could negotiate it and their existing lender would agree, they would be able to get an expanded loan facility of up to $35 million to make up the difference to get to 60. If their existing debt was $50 million, their potential expanded loan facility is $10 million. And if their existing debt is $75 million, they have too much leverage and would not be eligible. These also have a 5-year maturity and the similar attributes of the amortization as the other loans. However, the minimum loan size here is $10 million instead of $250,000, and the origination points are 75 to 150 bips instead of 100 to 200 bips. What are your certification and covenants to these loans? You commit to refrain from repaying the principal balance of any of your existing debt with these loans, unless you go ahead and use the priority loan facility and refinance it at the time of the loan. You commit that you will seek not to cancel or reduce any of your current lines of credit. And you commit and certify that you have no reason to believe that your business will go bankrupt in the next 90 days. While you have the loan, you can repay a line of credit, including a credit card, in accordance with your normal course of business. You can take out additional debt as long as it doesn't interfere with the rights of your new lender, and you can refinance maturing debt. You also agree to follow certain compensation, stock repurchase, and capital distribution restrictions. There are carve-outs for these restrictions for an S corporation or potentially other LLCs or other tax liability processes that you can make accommodations for your tax purposes. While you have the loan and for up to 12 months after the loan is full, you agree not to repurchase an equity security listed on the National Security Exchange for your parent company, or not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you agree not to make any more than that while you have the loan and for 1 year thereafter. If there are those on the call who earn more than $3 million, what you do is you take the difference between 3 and the difference. So say you earn 6, you would take 50% of the difference between 3 and 6, which is 1.5, and you could earn $4.5 million. You agree to make reasonable efforts to retain your employees while you have the loan. But I want to be clear that unlike PPP, where the priority is to maintain your employees, here the priority is to maintain your company. The lender will calculate your EBITDA if it is a lender you have used before, the same way they have historically done it for your company. If it is a lender that you have not used before, the EBITDA will be calculated in a similar way that they have worked with companies like yours before. Debt will include all outstanding debt, including with any loan facility, including unsecured or secured bank loans, non-bank financial institutions, or private lenders. The existing outstanding and undrawn available debt should be calculated at the date of the loan application. If you have an asset-based line secured by accounts receivable and inventory, that loan amount will be based on what you have actually borrowed, not what you might be able to borrow if the facility was at its full capacity. So how do you pick? Let's take an example of row number 2, a company with $4 million of EBITDA and $10 million worth of existing debt. If they wanted to get a new facility, they could get one of $6 million, or if they wanted to get a priority or an expanded facility, they could get them for $14 million. That choice would largely depend on what they could agree or negotiate with a new lender or their existing lender. What are some use cases for these loans? Financing strategy is both offense and defense. Example number one is a company with a $3 million line of credit and $1 million drawn. The line of credit has a personal guarantee. They are planning on getting an MSLP for liquidity to help them through the recovery. They would rather not personal guarantee the capital required to reestablish the business, and therefore plan to look for an MSLP lender that will not require a personal guarantee. Example number two is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And finally, is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much money will be required to get your business back on a stable footing in this new world order? What is the best case and worst case scenario? Where will the cash come from, and how much are you willing to personally risk? And what does your future look like? What opportunities are you considering, and what cash might you want to use to take advantage of them? That is the end of my prepared remarks. And now it's my pleasure to open up the floor for questions. Please be reminded that we're going to take questions from the Q&A. I know there are folks that probably have PPP and EIDL questions. We're going to take those last and concentrate on the Main Street Lending Program questions first. Thank you, Hannah.
Thank you, Ami. Can we apply for forgiveness at 10 or 12 weeks, or do we have to wait for the 24 weeks under the flexibility?
That is a PPP question. We'll take it now, but you have to choose either to do it at 8 weeks or 24 weeks. You can't use 10 or 12 weeks. It's one or the other.
If we take SBA EIDL loan, does that reduce the loan amount for MSLP?
It does, and you also have to be careful because the SBA EIDL was going to take a lien on your business. So that could create complications with the lender's rights. So it's a good chance you'll actually have to refinance it in order to take advantage of the PPP.
If I get an MSLP loan and put it in my company's bank account, could an acquiring company of mine use that cash to essentially buy me out, thus assuming the loan for the combined company?
Please repeat that question, Hannah. I'm sorry.
If I get an MSLP loan and put it in my company's bank account, could an acquiring company of mine use that cash to essentially buy me out, thus assuming the loan for the combined company?
I don't think so. Because that would mean that you have a capital distribution that would exceed your limits.
Can I use the Main Street loan to purchase or sell a business?
There's no restrictions that you can't use it to purchase a business. It's unclear how you would consider using it to sell a business, because if you sold a business, then you would be getting benefits from that, not need a loan for that.
Is there any update on monies for income of owner in an LLC?
Please repeat that question.
Is there any update on monies for income of owner in an LLC?
So we'll have to take that question offline. I don't understand it.
In regards to the affiliate guidelines, I have 4 S Corps that are all swim school businesses with 60 miles of each within each other. Are they considered affiliated? And if so, can I combine the EBITDAs and debt to come up with a loan for the possibilities?
Yes, as long as the ownership, you have a controlling ownership of each entity.
Is convertible note considered debt for maximum loan amount calculation purposes?
It's not clear to me whether a convertible note will be considered equity or debt. There's no specific guidance to it. However, our assumption right now is that it will be considered debt.
Isn't it assumed that all borrowers in the program have been severely affected by COVID-19? Why would companies unaffected apply for this? And if all are assumed to have been severely affected, why do you advise that they go only through their existing bank?
I don't think it's assumed that all borrowers would be severely impacted. I have not read any of that there. And why I would advise a severely impacted borrower to go to their existing bank is that that bank has some incentives to give them the loan, because they could lend them more money and only take 5% of the risk, because the bank is selling 95% of that paper to the Federal Reserve. I'm not sure what incentive a new bank or a new relationship would have to take a severely impacted company into this program.
Mm-hmm. Clarification. What is the minimum EBITDA requirement? I thought previously it was 250K. Is that no longer the case?
It's no longer the case. If you have zero debt, the bare minimum EBITDA requirement will be about $43,000. However, I want to be clear is I'm not sure how many lenders at the end of the day, even though the minimum threshold of the program is $250,000, are actually going to be able and interested and willing to make very small Main Street loan programs. That feels to me like more of a political consideration by the Federal Reserve. I just don't know how many lenders will really do such small loans.
Are nonprofits eligible?
Nonprofits are currently not eligible, but that certainly could change in the future.
Do credit card limits apply to debt availability?
I'm going to assume they do.
If I have an EIDL, will I have to refi to get the priority, or will the SBA subordinate?
We don't know yet. It's something that hasn't been considered, and the banks are waiting for guidance on. Greatest likelihood is you're going to have to refinance it. I don't think the architects of the program took into consideration the possibility that businesses who would be applying for these loans would also be applying for EIDLs.
How hard do you expect these MSLP loans to get for businesses that were significantly affected by COVID-19 and have good long-term prospects?
Much more difficult than if you were impacted on the margin. Again, if you were significantly impacted, I'm going to encourage you to start first with your existing bank where you have a relationship.
Do real estate mortgages count towards the total debt figure when determining maximum borrowing amount?
Our understanding is that they absolutely do.
Can you review the known or assumed uses of the expanded loan facility proceeds?
There's no difference in what you can use them for: to stabilize operations, keep operations, evolve your business, grow your business. You just can't use them to pay off the original loan first before the expanded loan.
Is there a list of banks that are participating and which banks do not require personal guarantees?
There's no list of banks that we're aware of yet that are participating. Most banks are just figuring out what they're doing, although we do have some term sheets for our clients out already on the program. So it's really the more entrepreneurial banks that are doing it right now. And there certainly is no list that I'm aware of banks that will not require personal guarantees. This will very much be on a case-by-case basis.
Can you expand on the rules for an affiliated group?
Yeah, any company that you have controlling interest of is considered an affiliated company. So if you have your real estate in a different entity and it's owner-occupied real estate, that's considered affiliated. If you own another branch or franchise of your business, 30 miles down the street or in another territory, that is considered affiliated, as an example.
Do 2019 taxes have to be filed? A partner in another company cannot file until later this summer.
They do not have to be filed, but the preference is going to be, if they're not filed, that audited financials are done or reviewed or compiled. Some of that might depend upon the relationship you have with the existing lender, but we are encouraging people who do not have audited financials, if their taxes are close, to get them done as quickly as possible.
Is there a minimum credit score required?
There's no indication of credit score on any of these programs. Doesn't mean that banks might not choose to run them at their own discretion, but it's not a requirement of the Main Street program. Just to be clear to folks, that banks have a lot more discretion about what they choose to do here versus PPP. In PPP, the loans were 100% guaranteed by the government. In this case, the loans are 95% guaranteed by the government. So the participating lender is taking some risk, and therefore they have some flexibility to add additional requirements as long as they don't conflict with the core requirements of the program.
Can you share any insight of the turnaround time for the new MSLP loans and how many weeks to get approved, etc.?
Some of that will depend upon the state of your financials, how complete your package is, and we're going to guess these will be a 30 to 45-day process. This is a complete underwriting process of a loan, unlike the PPP, which was fairly quick.
How is determination of significantly impacted made? What if our 2020 plan was for significant growth during 2020 and now we'll be lucky to be flat or minimal reduction of revenue compared to 2019?
I really think that will largely depend upon how your story is presented to the banker and how your bank interprets it. There's not a black or white image, but a lot of that will be dependent on the participating institution. Remember, banks don't make a ton of money making these loans, so they can't afford to be picky about what they are not willing to do.
Will there be a DUNS minimum requirement?
Please repeat the question.
Will there be a DUNS, DUNS min requirement?
I've not seen anything about that.
How much more complex of an application is this expected to be compared to the EIDL loan app?
There were different versions of the EIDL application, so I'm not sure, but you need to prepare for a thorough underwriting. You might compare this to going out and getting an SBA loan or a regular commercial loan in ordinary times. This will not be anywhere close to the relative simplicity of at least the PPP. The PPP forgiveness might be a different story, but this will not be anything related to the PPP, comparable to the PPP.
Any advice for a healthy first-time borrower about $1 million EBITDA and where to find new lenders?
Happy to discuss that offline.
Does the debt balance have any consideration to assets that they are backed by?
None.
What are the challenges associated with applying MSLP through another bank?
Well, you just have to make a good story, and it's possible that that new lender will want your deposit relationships. Just in many cases, like with the PPP, if you went to a new lender, many of them wanted, in addition to your loan, they also wanted your deposit relationships.
If I want to sell my business, can I use its EBITDA to support an MSLP loan for the buyer?
I'm not 100% sure of the rules around that. I would ask you to take that question up with us offline, and we'll get you an answer.
Is EBITDA calculated as strictly defined, or are there other ways to define it? For example, if there was a line of businesses that closed in 2019 that lowered consolidated EBITDA, can I remove the discontinued line of business in calculating the EBITDA?
You can try to remove it, but the question is, will the bank take it? So the bank's requirement is to calculate your EBITDA and make adjustments in the same way that they have historically made adjustments for similar companies like yours. And so some of that will be depending on what the bank is willing to accept or not accept.
If I have 500K of line credit card availability for the business, several of which are personal cards, do you believe that that counts towards debt availability?
I think the amounts on the business cards will count. I don't think the amounts on the personal cards will count.
2019 EBITDA was negative, still investing into product development, but 2020 running is positive. Are we eligible?
No,
Will severely impacted industries such as cruising have any priority, or does it depend on the financial institution?
100% depends on the financial institution. Now, keep in mind, and what it really depends on is how much liability that financial institution has with you. So say you already have $5 million of loans out with your existing bank and they're worried about getting them paid back. And say you are eligible, I'm just making it up, for a $4 million Main Street loan. Well, if the bank chooses to make that, they are only keeping 200,000 of that on their balance sheet and selling 3.8 of it to the Federal Reserve. So they might say it's worth it to take a $200,000 risk in order to protect their liability with you of $5 million.
Is this available for sole proprietors?
I don't think so.
Is expanded loan facility need some collateral or security, or is it a secured loan?
It needs the same security or collateral as the existing loan does that you have, that you're expanding based on.
By taking an MSLP, would there be any issue if sometime during the loan repayment period, an unaffiliated company decides to acquire the company that took the loan? For instance, we current owners in the business will be able to sell their shares for acquiring company even if they still have a loan?
There's no issue in being acquired. However, the question is if the owners are going to get a payday from that acquisition, and let's say at the acquisition the loan is paid off, the sellers might need to hold their proceeds in escrow for 12 months before they can get them.
Should MCA loans be separated from other existing debt?
It really depends on what the agreement says, but if that is an agreement to buy future receivables and not a loan agreement, they should be separated because they likely don't count in the debt calculations.
Will there be any mandatory support from third-party loan arrangements on the MSLP?
I don't think so, not that I've seen.
Can you review the uses of new or priority loan proceeds?
The uses are the same and they're pretty broad: to sustain organizations, to rebuild businesses, expand businesses. You just cannot use them to repay old debt.
Okay, we have two more and they're PPP.
Sure.
For PPP, during the 24-week period, if the payroll of hourly employees is reduced, does that reduce the forgiveness amount, even though there's no reduction of FTEs?
It likely will. The question is if it's reduced by more than 25%. If it's reduced by more than 25%, it will hurt your forgiveness amount at the end.
And for the rent payments, can we do advance payments for future months, or do we
No.
have to lease prior to? Okay. And one more, can capitalized R&D expenses be used for adjusted EBITDA?
That would depend on the lender.
If the bank sells the loan to the Treasury for 95%, does that mean the bank only takes 5% of the risk?
Correct.
All right. Thank you very much, Ami. Yep.
Ladies and gentlemen, thank you so much. I wish everyone God bless and Godspeed. We will, but later today, emailing you a copy of this presentation and the webinar, and also posting it on our community site at realtime.inc.com. If we can answer any questions for you offline, please let us know. Thank you so much. Take care.